And Jason Pry, the Director of Investment Strategy at Glenmede. Jason, let's kick it out to you. So we had a lot of selling on Friday, and that's continuing here. Do you see any signs of the market bottoming out anytime soon?
You know, we're starting to get to reasonable valuations now. We're talking about 13 times earnings power on the S&P. When you look over in Europe, actually, you see things trading at about 10 times earnings power. We're starting to hit levels 10 and below is where you kind of start, holding your nose and buying almost anything. 13 times on the S&P isn't quite there. So, we have this negative trend going throughout Europe. The U.S. is not perfect right now. I think people are getting more uneasy. At some point in here, the value buyers are going to step up to the plate, but I don't think they're there yet.
I was actually going to bring up a story today about bearish options coming to a high and Byron Wien saying to buy stocks and ask you guys about that. But fortunately, the guy who wrote the story just rocked up here on set.
Oh, hi, guys.
So we can talk to you about it. What is the options market saying here about stocks? And I want to talk about this with them as well.
What we're doing is we're comparing not your typical options, but kind of options that are lower down, what you might call crash protection. And we're looking at how those prices for, the level we're looking for is about 940 on the S&P compares to the equivalent options to bet on a gain. And what we're seeing is people are paying record levels for these bearish kind of crash options, if you will.
Do we see this often, Jeff?
No, we've never seen it before. And we ran back through 14 years of data, which is kind of as far as you can get. And this is eclipsing the peaks of the 2008 highs. So
yeah, my guys are telling me we've got a chart, and I'd love to bring it up. Hey, Jeff, talk what we're seeing. This is the price of crash protection. So this is what you're talking about. But exactly what are we seeing?
So we're just comparing the options that you would buy to protect against losses of about, like, what we're looking at is maybe 20% off the April highs versus an equivalent gain. And we're seeing that being bid up to the highest levels we've ever seen in the last 14 years. And so the question is this one of those things? Is this capitulation? Is this one of those things where you say that's a buy signal because everyone's so bearish?
Right.
It's time to buy.
You know what? Let's ask Jason and Matt, because I wanted to get their take on this. And Matt, let me start with you. I mean, Byron Wien says it's time to buy because everyone's so bearish. What's your take on this?
Well, I agree that forward PE is about 11, and a dividend yield about 3% is very, very attractive. However, we've had some severe structural damage to the economy because the housing market and the employment market just isn't coming back fast enough. Now, about that skew in the S&P 500 options, that's why us VIX traders are a little mystified. Normally, when the skew is that high, we would see extremely high volatilities in certain VIX calls, and we're just not seeing that. So it could be a continuance of a bearish sort of perception out there, and that the VIX calls just aren't performing as well as they should be, meaning we could have some lower where to go on the S&P 500, even from where we are now.
Exactly. So, Jason, I mean, do you listen to what the options traders are telling you? I mean, do you listen to the market here, or do you say this level of bearishness makes me just want to go in, as you said before, hold my nose and buy anything that looks cheap enough?
Right. I think you have to look at it from a valuation perspective. Once you hit really low levels of valuation, then you do have to kind of hold your nose and go in. But we're not quite there yet. If you remember, that historic buying point is somewhere below 10 times normal earnings, and we're just not there yet. So at this point in time, you have to kind of keep listening to what the market's telling you and listen to the information and take your time. You kind of our approach right now is actually to just be kind of a patient buyer of assets. We want to be picking up assets at a discount, but we don't want to be catching a falling knife unnecessarily too early.
Right, but so Jeff, so bear options at a record. I mean, some would say that that's a contrarian indication, correct?
Well, right, and that's something that we checked out when we ran the story. So we went back through all the data, and we found out right now people are paying the relative cost of bearish options is 70% higher, and we ran back through all the numbers and we said, what did that do? Every time that got above 50% premium for those puts, and what it works out to over the next 6 months from those points, there's about 34, I think, over the last 14 years. And it averages out to a 7% gain over the next 6 months. So, I mean, I love hearing that a VIX options trader is perplexed by this market, but that is the kind of interesting tension between the what's happening in the cost of protection and what people are saying. Stocks are cheap, and the economy is supposed to expand, and so
It's interesting to see.
Where do you go?
Adam and Julie, I know, are chomping at the bit here.
I'm chomping at the bit, Matt. I'm chomping at the bit. Jason, you said you're a patient buyer. That kind of tells me you got a shopping list. I want to know what's on your list.
So we're actually interested in the European marketplace. On the whole, we're interested in emerging markets, given how much they've backed off. What we're looking at is a little bit different from what these guys are looking at. One of our key indicators is 3-month LIBOR. You know, one of the main concerns that still sits out there is bank solvency in Europe. LIBOR's basically been increasing since the middle of May. It's flattened off now, but it hasn't declined yet, basically meaning that, you know, banks are not as willing as they were to lend to each other before. And until that lending appetite between banks, at least on a 3-month basis, comes back into the marketplace, I don't think we're necessarily going to see a huge amount of stability until that point. So we're watching that as a leading indicator at this point.
Hey, Jason, it's Julie. So just quickly here then, so it's not just going to be that things have to get to a certain cheap level. It's that also you have to have these other perhaps negative factors lighten up a bit also.
You know, it can be a combination of the two. That would obviously be the ideal environment. There is going to be a point where it gets low enough that it's a hold your nose and buy no matter what. But right now, we're not in that territory, so you have to have these other indicators to watch to see when things are getting a little bit better. Because reality, we might not get to the point where things are so cheap that you can hold your nose and buy them. We may have something that recovers before then, and you want to be positioned and watching so that you know when to do that if it comes about.
All right, hey, Jason, thanks so much for joining us. Jason Pride there from Glenmede. We want to thank Matt Shapiro from NWS Capital.
Thank you.
As well. Jeff Kearns with a fantastic new haircut.
You guys kind of look like twins here.
I want to personally thank you for joining us as well. And also such an opportune, such good timing, I should say. Adam and Julie, always a pleasure.